Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I am a financial advisor, but this video is not financial advice. But hey, how much GameStop should you hold in your portfolio? I'm not going to tell you the answer, but I'm going to help you discover the answer for you. Again, my financial advice is for my financial clients. If you want to consider hiring me as a financial advisor, that's a totally different conversation. This video is for education, for information, for the masses to glean for themselves. How do you go about thinking about making an investment in GameStop, period? And what percent weight do you put into GameStop? Should it be 100% of your portfolio? Should it be 2% of your portfolio? Should it be 100% call options or should it just be shares? I am going to deep dive into, dabble into how would you go about thinking about that for you, at least from my perspective as an investment analyst, as somewhat of an expert on GameStop as a company at this point, and as a financial advisor who is a fiduciary, okay? Legally obligated to prioritize my clients' best interests, not a private equity firm, not a hedge fund firm. Okay, before I do that, thank you so much. We crossed 1,000 subscribers. Credit to you guys. I'm really, really excited to mindfully think about anything special that I can create as a channel for the early subs and crossing 1,000. I can, um, have memberships, and I've been thinking about maybe creating some type of kind of fun community, not a Discord, not like me, the guru guy, but just how do we just give back to you guys who have subscribed and I'll think about that. I'll keep thinking about that. I'm much more interested in making sure that everyone that views, regardless of any type of channel monetization, I want everyone to have really the same viewing experience, the same content availability, and I want to maintain my clear authenticity and kind of freedom from conflict of interest more than anything else. But I will be thinking about, anything fun we can do for anyone that wants to become a next level fan or follower of Budget for Life. So let's dive into GameStop as a part of your portfolio. Um, New tab on the spreadsheet here titled Portfolio Management. So I am about to make this bigger so that you can see these words easier, but I wanted you to see that this is a matrix here: risk and reward, micro, and macro. So before I dive into GameStop specifically, I want to kind of walk you through what kind of makes up a portfolio and what scenarios are you trying to prepare for as you're creating that portfolio. And what I mean by macro reward and macro risk is really the big picture economy. Okay, so what if we're hitting booming times? What if we're hitting a big recession? How do those scenarios impact your investment decision making, your portfolio construction? And then on the micro level, I'm really talking about your specific investment allocation. So it could be if you're, for example, buying GameStop stock, that specific company shares, what's the upside and what is the risk, the downside of that specific company. But you could invest in things that are, more broad than a singular stock, but still a decision, right? For example, you could say, I want to invest in an index that represents the tech sector. So it's this basket of, dozens or hundreds of companies, or you could say, I want to invest in the Russell 2000. You could still, again, say, okay, what's the really the best case scenario? What's the worst case scenario? What's the risk versus reward of that decision? And again, how do we think about making a portfolio in light of the different possibilities that any given investment could have? So let me kind of take this quadrant by quadrant, and then there's more after this. Okay, so stick around. You're going to want to see it. So here we are, this top corner here. Best case scenario, your decision hits, and the macro scenario is really bullish. really what you're thinking about, what you're trying to solve for is how do I maximize my return? And some typical assets that someone would invest in to try to maximize their return, assuming that you're correct on your investment thesis and that the macro conditions are supportive, would be growth-oriented equities, real estate, developments, venture capital, or even derivatives. For example, call options. These would be some assets you might consider to maximize your upside. Now, in the scenario where your specific decision does great, you made a good decision, you fundamentally outperformed within your investment thesis, but the macro scenario is really difficult. Really, you are solving for how do I limit my downside risk? You could pick the right company at the wrong time, and it could have a significant impact on how the company performs, not because of anything the company did, but just the big picture economy. And when you are, chartering through rough waters, you want to think about how do I protect my downside? What if things get really bad? Some typical assets you would think about are blue chip equities, bonds, or single family home rental properties. Things that you would say, you know, things might be rough, but these types of assets might do better than the rest. And on the other side of this quadrant, you've got your micro risks paired with your macro scenarios. Let me freeze this so it can come down with us. So, what if fundamentally your company underperforms, but the macro economy is doing really well? Again, you're solving for how do I limit my downside risk, right? If my specific company does a bad job, I want to know how am I going to be protected? And some typical assets you would think about, one is just diversified equities. Rather than having just one company, well, what if this one company does poorly? Hey, that's why I have a lot of companies, right? You could also look at REITs, so real estate investment trusts. So instead of having a specific, rental development or this private commercial development, you could say, hey, why don't I just invest in the broad basket instead of picking a specific real estate sector, right? Let me just get into some broad real estate indexed securities. Bitcoin could be another example of this. I know the thesis of Bitcoin is that it's really an inflation hedge. Hopefully, right, it would do better when the economy is doing bad. But so far, historically, really it's associated. Bitcoin generally runs more as the equity market is also running. It hasn't exactly inversed market conditions. And collectibles could be another one where, okay, maybe a company doesn't perform well, but if times are good, then I bet collectible values might go up, whether that's art, whether that's trading cards, kind of alternative investment plays might be an asset class that you would think about to protect your downside risk if your specific decision making goes poorly in the middle of the greater economy going well. And this bottom quadrant here, where both your specific decisions are kind of in the worst case scenario and the macro conditions are in a poor scenario, what might surprise you is what you're solving for here, which truly is how do I maximize my return? And most of you probably wouldn't think about that, but think about these assets that you might consider investing in kind of the doomsday worst case scenario. You're talking about cash and commodities, you're talking about T-bills. You might even have derivatives like puts or also negative beta equities. So companies that are historically a negative beta company is a company that has been underperforming or at least was underperforming. And maybe it's heavily shorted. Maybe it's headed for bankruptcy in some way. So, right, it's fundamentally underperformed. But if you can own a company like that while simultaneously the greater market's crashing, well, that negative beta is going to create an inverse relationship, or that inverse relationship that's already there is going to create an outsized return. Now, think about cash with me for a second. You might think, oh, having cash, how is that maximizing return? It's like, well, if everything is going down, everything's cratering, then every dollar that you had already on the sidelines relative to the values of securities is performing the best. And then you have the opportunity to then buy securities at that discounted price, which then, so not only did you save yourself a 40% loss, for example, so you're already 40% up, but then you get to buy an equity, you get to convert some of that cash or some of those commodities into a depreciated security price of this blue chip equity or this real estate asset, right? And that discounted purchase price is going to significantly enhance your upside over the coming 1 to 5 years as well, where some people are going to be breaking even in 2 years and you're going to be on your way to, well past a double in 2 years. And so when someone is being very like doomsday, sometimes public media, personalities, financial media, they talk about how everything's going to go horribly. A lot of times they are not focused on limiting their downside risk. They're really focusing on maximizing their return. They're really saying, how do I do the best if the worst case scenario plays out? And being in cash, for example, or a negative beta equity would be an example of how can you do the best in the worst case scenario. But often, holding cash, for example, would do the worst in the best case scenario. If everything's roaring every year that you're sitting in that cash, you are missing out on another 20%, another 20%, another 20% growth. And so the risk of being in all cash, if we happen to have a really bullish macro situation, and if the alternatives that you would have invested in would have done really well, then again, that's an example of a risk that you chose to try to maximize return in a worst case scenario, um, because you miss out on the return in the best case scenario. When waters are choppy, nothing is, there's not as much opportunity for as explosive of growth either way, but there are still, generally speaking, investments you could make that relatively would outperform and that could leave you in a better situation. I'm going to show you kind of the next level of this in a minute as far as what do you do, how do you take these implications a step further into investment decision making, and how does GameStop come into play? Before I do that, some general portfolio considerations. Just at a high level, what do you do with this matrix that I just presented? So the first thing is, what's the probability of each scenario? Right? So I just talked about the doomsdayer that comes on some channel and talks about how everything's going to go so bad and they're in 90% cash, right? Probably there's several things that are true of that person, but one of them would be that they ascribe a much higher probability to the worst case scenario than maybe the average person does, because they ascribe a 50% chance of a severe recession in the next 12 months, whatever the number is. Then it makes more sense for a higher portion of their portfolio to optimize for that scenario, right? And I made all of these quadrants green on purpose because there is always a way to make money, right? There's always a way to make money. There's always assets that are going to outperform. But what we don't necessarily know is the future. We don't necessarily know the macro future. What's the big picture economy going to do? Particularly when you limit yourself to a specific time horizon. In this next 2 weeks, what's going to happen? You don't know, right? The further out you get on your time horizon, the more accuracy you can have. And that's true both the macro and the micro. But this micro risk I colored this yellow to indicate that, in my opinion, micro risk is the easiest of these four variables to, I wouldn't say predict, but to know, to study. There's there's almost a base level factual reality to the specific risk of a specific situation. And for that reason, a lot of times I think diversification as an optimizing asset class is kind of like it's not necessarily the easy way out, but well, it is kind of the easy way out because to mitigate specific micro risk or to assess specific micro risk takes a lot of work. And so the easier way is just spread your eggs in as many baskets as possible, right? But if you have the capacity to deep dive into the fundamental risk of a specific investment decision that you're making, you have an ability to mitigate against this quadrant in particular. So, back into portfolio considerations, and then I'm going to dive a little bit more into that yellow that I'm talking about. So, what's the probability of each scenario? What will your investment performance be in each scenario? So, you don't need to know this, to a T, but generally speaking. So, let's get super vanilla here on the, reward quadrant. Let's say you invest in a venture capital opportunity, a startup, and you put in $1,000. Let's say the startup doesn't make it, right? In that scenario, every dollar you invested will be zero, right? Or an example within GameStop, call options that are far out of the money and near dated, right? I wish I wish you knew how much money I have lost on out of the money near dated call options back in 2021, making mistakes. Several ways I could have identified that as a mistake, but I was earlier on in my investment journey, and turns out we learn from our mistakes, don't we? At least we have the opportunity to. If the underlying asset is not greater than the strike price at the time of expiry, that call option is worthless, right? Worthless. In the venture capital example, if you are a super early investor to a startup company or to a young company, or let's say you were Ryan Cohen buying GameStop shares back when GameStop was worth $100 million, there's really no, exactly how much money can he make in the long run? How high could GameStop go? You don't have to know that exact number because it's orders of magnitude greater than $100 million as far as the valuation of the business. At this point, it's what, 10 times, it's like 150 times higher? Is that true? I think that's true. At about a 15 bill mark, well, if it was at 15 billion, I think that would be 150 times upside. So let's just call it a 10x for the average Joe, average level of early investor. Say, okay, if this plays out, we're going to make a 10 times return, right? And so then you have a probability of each scenario happening, and then you have investment implications to each scenario happening. And that changes based on the different types of investments you're looking at. The variance can be a lot smaller if you wanted to invest in assets that are a lot less volatile. But there's probabilities, there's hypothetical performance, and then comes the job of the portfolio manager, which if you're self-managing your money, that's you, right? How do you assign weights in your portfolio so that you are comfortable in each scenario? That no matter what happens, whether you are right or you are wrong, whether the times are good or the times are bad, you end up with a net outcome that you're comfortable with. It doesn't mean that every outcome you make $1 million, but based on the probabilities that you ascribed with the information you currently have, that you are comfortable, right? So let's say you thought there was a 90% chance that the macro economy crashes. And let's say you end up being wrong on that probability, and or that you were right on the probability, but that the 10% scenario actually happened, where the economy booms. As long as you are making decisions that, given the information you had at the time, you were able to optimize according to the weighted probability of each scenario, then you should be able to live with yourself with contentment, with fulfillment, and protect kind of your worst case downside risk scenario. So let me dive into mitigating against micro risk, specifically as it relates to picking a stock, because now we're getting a little warmer into how much GameStop should you hold. And there's a couple questions you need to ask yourself when you're picking any stock, period. The first is, what is your level of understanding of the company? That means how clearly, like, how much can you understand the company personally? Not just how much does someone else understand it, but how well do you understand it? The nature of the operation, like what the company actually does, how it makes money, what the catalysts are, what the risks are. And some of that is also related to how much does the company disclose. Some companies are very hush hush about anything that they're doing. Other companies are much more forthcoming with what they're working on and what they're building. So, what's your level of understanding? And then, how does the company fit in your portfolio? What role is it supposed to play? Thirdly, what is your tolerance to volatility? Any company is, what I'm saying is, you can understand the downside risk of a specific company very well, potentially through research and application. But what is very hard to predict is how bumpy is the ride going to be, right? If it's up 100% today and down 50% tomorrow, how is that going to affect you? And then how long is it going to take? Right? You could be dead right about Tesla when you bought a share in 2011. But did you know it was going to be 8 years before you made a buck? You know? And did you know that in year nine you were going to make 15 bucks? Right? Like, what is your true time horizon as it relates to your investment allocation? And then lastly, what's your process for reevaluation? So, how are you going to consider the degree to which change has occurred with your personal circumstances or your investment thesis, the company, right? So we talked, in a past video, I was describing the performance history of GameStop historically over the past 5 years. A lot of people got involved, myself included, in GameStop right here in January of 2021. In January of 2021, it would have been an incredibly, incredibly risky decision as it relates to volatility, at least with going 100% weight into GameStop shares. But since then, the company has improved in so many ways, right? They're making, almost $1 billion more in an annualized basis in 2025 compared to what they did in 2021. They have $8 billion more in the bank than they did back then, right? So, in your personal life, what has changed in your life over the past 5 years? Do you are you making more money, or are you making less money? Are times harder or times easier? Is your time horizon the same? When a lot of times when people bought a share, I bought a shirt with a diamond emoji and a hand emoji on it, like diamond hands, never sell anything. Well, how has life treated you? And can you afford to never sell anything still? Has anything changed about you that, if you're going to respect yourself, should have an implication onto your investment portfolio? Hopefully, this is making sense so far. I want to give you time to chew on it, but let me kind of illustrate what probabilities could look like within these different scenarios. Let's say on any given decision that you're making, you say there's a 10% chance that it's the best of the best and a 40% that it's good, but 40% that it's bad and 10% that it's the worst. And same goes for the macro. Now, you could change these probabilities as much as you wanted to. Within any given investment, you could then go into, the greater quadrant and then the sub quadrants, right? You could get as granular on this as you wanted to. Like if we're talking about GameStop, for example, you could say, well, what about the 1% chance that, MOAS happens? And you could say, I think it's a 100% chance. Well, if you genuinely think it's 100% chance that MOAS happens, then what are the implications for that as it relates to your portfolio? And are you comfortable with, the downside risk depending on how you are going to play that, right? Again, you could be right, but if you put it all in call options and it doesn't happen in the specific time window that you thought it would happen, well, now your downside risk is genuinely 100% loss. And are you comfortable with that, right? So you could get as granular as you wanted to with how many sub boxes do you put in here. But then you can ascribe investment values to what would a share be worth in that scenario, right? From at least the company perspective, from the column perspective. And I'm not going to do that here. I think in future videos, I want to dive into, each quadrant at a really granular level, thinking about GameStop and thinking about the implications of the share price based on different possible future scenarios. Again, that still doesn't tell you what you should do because we can build out this whole matrix super specifically, but you still have to be the one to ask yourself these questions as it relates to your investment portfolio and your investor profile, your risk tolerance, and your time horizon, right? Personal finance, it's 1 part finance, 4 parts personal. Okay. So you have to respect yourself in this process, and you should never let anyone online bully you into any specific investment strategy. Certainly, I do not bully my clients into any specific investment strategy. But what you can do with GameStop is say, what is the gain or the percent return in a good scenario as it relates to the company performance? What's the percent return that I think it'll have in this bad scenario? And then again, you assign each of those probabilities, you weight them according to, well, assign each of those outcomes, you weight them according to the probabilities that they happen. And then you hopefully have an idea of what type of concentration would make the most sense within this particular investment decision. And what I want to propose as I kind of get towards the end of this video is that what's usually true from a portfolio construction perspective is not always necessarily the best way to construct a portfolio. Let me say this differently. GameStop, in my evaluation, has a unique ability to be an optimal portion of your portfolio in all 4 of these quadrants, in all 4 scenarios. Whereas typically, right, there's a specific group of assets that might make the most sense in a particular quadrant, but would not be optimal in another quadrant, right? A growth equity, right? A growth stock with a super high multiple, with a super high sales growth. If we hit a screeching halt on the macro economy, well, that company could be doing everything right, but it is going to come down. Why is it going to come down? Because sales are going to slow and because the earnings multiple that company is getting is going to compress, right? We talked about cash. If things have an epic crash, everything's doing bad, you could maximize your return by having sat in cash and commodities. But even though that's an optimal portion of your portfolio, you know, within this quadrant, it doesn't mean you should be 25% cash, by the way. I'll talk about that in a second. But even if it's optimal in this quadrant, cash would be the worst thing you could possibly hold in this scenario where everything's doing great. And again, the blue chip equities and the diversified equities in these kind of choppy waters quadrants, again, usually that makes the most sense in these scenarios, but being super diversified does not help you in a scenario where the macroeconomy is doing great or where specific companies are doing great, where you could have allocated with a little bit more active management, or a little bit more clarity or focus on your investment strategy without as much fear of downside loss. But because you wanted to invest in 2,000 companies at the same time, you don't have the ability to substantially profit off of some that are doing incredibly well. How much weight should each of these quadrants have within your portfolio comes down to your risk tolerance and it comes down to your perceived probabilities of each scenario, right? How much should you plan for the micro decisions having a high risk, a high bear case scenario, and the macro having a high risk, high bear case scenario? Well, it's depending on how likely do you think that is going to happen, right? Firstly. And then secondly, if that does happen, let's imagine that you were 100% in growth equities, that in this scenario would be down 60%. Can you sustain a 60% loss if you knew that over 5, 6 years, maybe it'll still overperform, you'll make your money back, but you miss out on what could have been doing even better, right? You could have had cash to invest on that dip. You could have had a negative beta equity that spikes on that dip, right? So it's what's the probability and then what's your comfort level with that outcome as it relates to the implications of your portfolio. That kind of gets you to what percentage of the pie do you want to put in each quadrant, right? So you might say, I want 60% of my portfolio to be on this quadrant right here, the macro, supportive conditions, fundamental outperformance. And I might want 10% with fundamental outperformance and difficult macro conditions. And I want 10% of my portfolio with fundamental underperformance and supportive macro conditions. And I want 20% of my portfolio to be prepared to optimized for a fundamental underperformance and difficult macro conditions. Well, now you know that 20% of your portfolio is dedicated to this quadrant. Now, how do you divide that 20%? Do we just do 20% cash? Or do we do 5% cash, 5% T-bills, 5% puts, 5% negative beta equities? Do I do an index of all negative beta equities, right? Or do I get granular on what are the specific negative beta equities that I think make the most sense? Are you tracking with me? So there's dividing your quadrants, and then there's dividing into quadrants, I should say. And then there's dividing your quadrants. Okay, most people are not doing this. Okay, I don't blame you. This is literally my job. So I'm not like shaming anyone that doesn't invest like this. I'm just saying, from my perspective, how do you go about constructing an investment portfolio? And if you are someone that is highly interested in GameStop, as I am, the question then becomes, other than the specific question to you, your ability to tolerate volatility, your time horizon, etc., your probabilities, the question really becomes, what if GameStop is actually the superior, or I should say, a superior investment decision in all four of these quadrants? So at a super high level, what's the best case scenario if the economy is booming and GameStop is crushing it? The upside of GameStop, how should I say this differently? Like if you if you do you feel like the returns, the upside is competitive with alternative scenarios? For example, you could invest in Microsoft, right? You could invest in Tesla. You could invest in Palantir, like these kind of high risk, high return type companies. If everything goes right and if the times are right, they're going to crush. Okay. And does GameStop have enough upside to compete with the upsides of those other companies? I would say they definitely do, particularly at their current valuation. All of these conversations are relative to, well, what's the going rate? What's the going price? What's the current market cap of the company? If GameStop right now was worth, was trading for $500 a share, let's say, which would be a 20, right? A 20x on their market cap. So if they were right now a, whatever the math of that is, $250 billion company, what is the ability for GameStop to grow substantially from there in the best case scenario? At that point, you're really just talking about a short squeeze, or you're really needing a lot more data on what are they going to do to deploy their cash, right? But if, as currently constructed, if they keep all their cash in cash, right? And if, let's say shorts never close, right? They just kick the can forever. Well, then the ability for GameStop to perform in a way that competes with some other high growth opportunities in this quadrant, I would say that would become a little bit harder to argue. But when GameStop's trading at just about at book value, at cash value, well, the upside, it's not difficult to envision a 10 times improvement, even if they don't deploy any of their cash ever, just based on the growth rates already happening in their retail business between trading cards, the Nintendo Switch 2 and console cycle, and the Lego partnership that just began, and all three of those, portions of their business are slated to continue to grow. And their business right now is valued at 2.5 billion. Yeah, it is not difficult at all to imagine this company being worth 20 billion, which if the retailer is worth 20 billion, then you add in the cash value, or the market cap that's being given to GameStop, the hedge fund, you end up with a total market cap of 32 billion, which would be just about a 228% return, right? That's not hard to envision at all as far as what's GameStop's current upside. So, if you wanted to solve in your portfolio to maximize for the best case scenario, it's like, well, hey, are you comfortable with the best case scenario being, several hundreds of percent return? And you're just thinking about like a 3 year window, over the next 3 years, if your portfolio went up 5x, is that good enough? Like, is that pretty solid? I would say yes. And I would say those numbers are still relatively conservative in terms of what's GameStop's best best scenario. We're not talking about booming growth. We're just talking about if they continue to grow, continue to execute on their already established trajectory, does that give us upside that we feel is optimal as a portion within our portfolio? Now let's talk about the worst case scenario. Normally, you might want to have a portion in cash, you might want to have some T-bills, but what if the company you're talking about in GameStop, what if 90 plus percent of the market cap is represented by cash and T-bills, right? This company basically is cash, right? So if it's almost like, could GameStop serve as a cash portion of your portfolio because of how substantially the market cap is overlapped with their actual cash? And then secondly, GameStop does have a negative beta. So if you wanted to have a negative beta, could GameStop be the optimal play as far as a negative beta company, whereas several other negative beta companies might be, you know, in a different scenario, like in a boom scenario, they might be 3 months away from going bankrupt. And the only way they pop is in a short squeeze scenario and a market crash scenario. But GameStop still has a negative beta despite its bankruptcy risk being lower than essentially every single publicly traded company in the world. And so, would it make sense for GameStop to represent that portion of your portfolio? Would it make sense for them to represent the cash portion of your portfolio, right? Is the upside, the best case scenario, high enough to say this really is an optimal portion, an optimal allocation for this strategy? Is it an optimal allocation? The upside in a crash scenario, is it encouraging enough for me, supportive enough for me for GameStop to represent a portion or a significant or all 100% portion of that portfolio for me? Now, what about if the company does great, but the economy is really struggling, right? What is going to set itself up to be really enduring? And again, this is relative to current market cap. So the more that GameStop grows, the more again that you will want to continue to reevaluate its position in your portfolio and to know what is the role that this company has in your portfolio. Is it there only for the best case scenario? And is the best case scenario meant to be 100% of your portfolio? That's a question for you to answer. But I'd say for my clients, a big portion is devoted from each quadrant as it relates to why does GameStop make sense? Its upside is meaningfully higher than essentially any alternative. It's in a boom scenario. Its upside in a crash scenario is really meaningfully higher than any of its alternatives. And now, let's say the economy is really tough. Well, what's that going to do to GameStop? Well, they happen to be a video game retailer, and video games happen to be the most recession enduring sector in America. So generally, we think about utility companies, energy companies, consumer staples being, hey, these are companies that maybe they'll go down in value, but not by a bunch because people still need to buy these things. Well, it just so happens video games are more um, are even more of a good performer, I guess, a higher, uh, even less of a change in their revenue based on whether we're in a recession or not than any other industry. So they function like a blue chip company. They function in a very stable way. But even if you were to say, well, what if they don't, right? What if they, video games go down? What if people don't want to buy the Switch 2 as much? What if Legos sales go down? What if trading card sales go down? Well, GameStop's in the position where, again, so much of their company is, even if their PE multiple were to come down to industry average or slightly below industry average, based on their current valuation, that would represent their value going up. They are already valued below any other retailer in the industry. And other retailers, clothes, for example, do horribly in big recessions. Clothes retailers are trading currently at a valuation that's much higher than GameStop's valuation on a multiple basis, right? And so the downside risk of GameStop in terms of its valuation seems to be quite low. And the odds that their company would be able to sell, like for their sales to go down when they are just beginning to add in new products from consoles, trading cards, Lego sets, like for their year over year sales numbers to decline in the middle of brand new, highly desirable products for sale is, I mean, the odds of that are super, super negligible. I mean, almost impossible, right? Truly. And what are the costs of operation, right? If you're talking about a macro condition that's doing poorly, times are getting tough, stores aren't doing as well. GameStop is in a position where their stores are so uh, the portion of their costs associated with stores is so low, and their ability to close even more stores is so high. Just in this current year, they have almost 1,700 stores available, expiring, right? Leases that are expiring. So if we hit a super hard time in the market, they can cut costs for free. These are just expiring leases. All they have to do is not renew them, right? And then some of these stores, are coming off the books because some of these stores are related to Canada and Europe, which are Canada's already sold and Europe is being sold, right? So their costs are so low, their efficiency is so high. The sector that they're in is such an enduring sector in the market, and the timing of the upside of the company in terms of the types of products they have for sale, the new products coming online, those are all significantly mitigating factors for even if people were super broke, GameStop can continue without much of a difficulty, particularly when you're thinking about other blue chip equities or even bonds, single family home rental properties. Another thing to consider with all of those assets is those all imply debt, right? The worst thing about a recession, the scariest thing I should say, is bankruptcy risk. And in GameStop's situation, they don't have any they don't have any net debt, right? They have much more cash and securities than they do debt on the books, right? So there's no bankruptcy risk. There's no even operational risk. I mean, every company has risks. You can't guarantee rates of return, right? But it's not something that you're worried about, like sales plummeting, just from a macro situation going poorly, because again, the valuation of the company is already so low. If the GameStop's upside was already being priced in, then again, that changes the conversation. But when GameStop has basically no upside priced in, they're already priced as if they are doomed. From a multiple basis, they're priced as if the company is doomed. So if the company does great, the economy doing poorly is not going to be enough to keep the valuation so suppressed. Now, what if the company does horribly, right? You could say, well, I want this quadrant to be super diversified. That's how I'm going to mitigate this. And again, you're also asking yourself, what's the probability that they do horribly? And some of this could be out of your control, right? You could say, well, What if, some people come and violently obliterate every GameStop store and employee, and you'd say, I think that's a 0.0001% chance, but what if, right? What if something super uniquely happens that just crushes GameStop? What if the government comes in and says you're not allowed to be a store anymore because you're a meme stock, so you can't be in business? Again, the question that you're solving for is how do you limit your downside risk? How do you limit your downside risk? Two things I would say here. One is again, how much further can GameStop go down? Well, are the stores immediately worthless in even these worst case scenarios? Can they not even sell through at least some of their inventory in some of these worst case scenarios? And is anything preventing them from utilizing their cash to pivot into a different business? Or is anything preventing them from keeping their cash so that if they want to stay um, prepared for the worst case scenario, well, hey, their market cap as of today is $11.7 billion, and their cash value is 9.2 plus 1.9 on the way coming from the warrant dividends. So that puts you at 11.1 cash value. Let's say some of these assets get you a little bit of money, or let's say they get you no money, right? Let's just be super extreme on how bad can the worst case scenario be. GameStop immediately is worthless. The company is gone. They're not going to be able to sell anything. Everyone is dead. Like, which by the way, if that happened to any other company, they would go bankrupt, right? They would become worthless, which is why when you're solving for this quadrant, typically diversity is the answer, whether through equities or REITs. Maybe some alternatives or Bitcoin could help you. Well, guess what? GameStop's not like every other company. There's a couple reasons why that's true. One, I just showed you, is the cash value that's on the books. At the very least, the worst case scenario, the cash will still be worth cash net of their debt payments, right? Net of their expenses. And you don't have to worry about the convertible bonds in this scenario because it's just going to convert into equity. And unless the equity is not worth that, in which case it's like the convertible bonds also aren't worth anything. They only convert, they only have value in the case that GameStop performs. But that 11.7, right? GameStop's immediately worthless, so they're worth what, 11.1. And then how many zeros is that? Make it a dollar thing for me. So what's the downside risk there? Right? $600 million downside risk on a market cap company of $12 billion. That's like less than 10% downside in the worst case. But that's not the only reason why the downside is so low in this particular case. Another reason is because the money that they make from that cash exceeds their total cost of operations. So their total cost of, their SG&A, if you net out the cost of their stores. So let's say the stores get wiped from the face of the earth, and now but you still got your employees, right? You still got to pay your taxes. So you got to pay property tax for the corporate office. Their SG&A is $30 million for the whole company and coming down still. And their interest income and gains is $100 million. So even if the company didn't make any more sales, they never sold a single thing again, all the stores get wiped off the face of the earth. RC and all the executives are terminated through crazy assassins. They still net profit without having to downsize their corporate office, without having to change anything. Their money is going to continue growing. Their money is going to make money faster than they cost money, right? So then they just become a super SPAC ready to merge into another business whenever they want to. But in the meantime, their net income is going to be over $70 million every quarter. And so, again, what's the downside risk from the current market cap valuation? It's like it's so low. It's basically negligible. There's one other reason why GameStop could represent a portion of this quadrant for you in your portfolio, and it's the fact that, oh, they happen to be a global leader in Bitcoin and in collectibles. So if typically an asset that would perform well, an investment decision that would perform well, should you fail on the micro level, would be, man, you maybe should have held some Bitcoin. Maybe you should have done some alternative investments. Well, guess what? GameStop has a huge inventory and a growing inventory of alternative investments through PSA graded cards, and they have $500 million worth of Bitcoin, right? So again, there's so many factors why GameStop uniquely, very uniquely, this is not typically the case ever, right? This is why this company is such an attractive investment in a portfolio right now, is because it doesn't make sense how cheaply it is valued in light of its downside protection, whether the big picture or the small picture, the economy or the company does horribly, they are so well protected on the downside. And their upside, if everything hits the fan, and their upside, if everything is firing on all cylinders, are so meaningfully high, and you're not paying a premium for any of it, you're paying a huge discount for it. You're almost getting it for free. You're almost getting it for free, meaning the market cap that GameStop's trading at is almost equivalent to its net cash. Once you factor in the warrants, which I would be shocked if GameStop does not raise money through it. But even if they don't raise money through that 1.9 billion, what's going to stop them from raising money next quarter and next quarter and next quarter? So far, there has been no slowdown and no softening of demand for GameStop, the capital raising entity. GameStop, the hedge fund, is becoming more and more valuable, even as the retailer is whittling away. So, all that to say, how do you weigh GameStop for yourself, particularly? Of course, ultimately, that is your decision, right? It comes down to you. But for my clients, why does GameStop at times have an incredibly high weight in your portfolio? It's not because, ha ha, GameStop to the moon, nothing can go wrong. I'm going to be the genius financial advisor. No, it's because I personally assign a relatively meaningful weight to what if the macro conditions worsen? And by the way, they're already pretty tough on Main Street. I assign a decently high valuation to the downside scenario of the macro. I have, through research, been able to limit my downside within GameStop in particular, right? The unique downside of this specific company, even in the event that the company fails, or even in the event that the company is uniquely targeted, right? That they are attacked and decimated. Even in those scenarios, by current valuation, the downside risk is meaningfully higher than any alternative I could think of, right? And then the upside, of course, is certainly very encouraging, and you're getting to participate in that upside for free. So the upside, of course, is a big factor. And we'll talk in another video about how high can GameStop go, etc. But hopefully this breakdown gave you an idea of how do you go about thinking, how do you go about thinking how GameStop should be represented in your portfolio? I guess one other comment I just want to make is that as far as shares versus call options, is that first question when you're making a specific stock pick, a specific investment decision, is how well do you understand this company? How well do you understand this asset? If you are buying a derivative, the question is no longer how well do you understand GameStop? The question is, how well do you understand this derivative? And if you do not clearly understand with a high level of with focus, right? If you don't have some history, some expertise on derivatives, then I personally would not recommend that you dedicate a meaningfully high portion of your portfolio to an investment that has a high chance of becoming worthless that you do not understand, right? Even if you understood it, if it had a high chance of becoming worthless, it shouldn't be a substantial portion of your portfolio, or I should say, it shouldn't be a substantial portion of your net worth. These quadrants I'm talking about are really from a net worth perspective, and it could be that only 5% of your net worth is in your investment portfolio, in which case you can treat it all like lottery tickets. You can treat it all like YOLO if you want to, and it might still fit within your risk tolerance because really all your money is in your business and all your money is in your house and all your money is in your cars, right? And then all your money is in your 401k, and then your investment portfolio is just a tiny little part of your actual investment portfolio, your actual net worth composition. But from a net worth composition perspective, certainly you want to qualify anytime you're making a specific decision on a company or an investment. How well do you understand that asset and what role does it play in the portfolio? So hopefully that gets your gears turning a little bit. Again, thank you so much for taking my channel across the 1,000 subscriber benchmark. I'm super thankful for that. Glad to have you guys around. If you learned anything, drop a comment below. Let me know what you appreciated. And again, plenty more videos coming soon on GameStop fundamentals. All right, see y'all in the next one.